If you live here in New York City, you know that the psyche in this town rises and falls with the stock market. So there has been some elation, but mostly deflation over the course of this week. We wanted to know how investors elsewhere in the U.S. are taking the market ups and downs. So right now, we're going to Kansas City. And James Moffett, Chief International Strategist for Scout Investments. Jim's Scout International Fund outperformed 90% of its peers over the past 5 years, and he manages about $7 billion. Jim, it's good to see you again. What's it like in Kansas City? I do want to ask you about your investment strategy, but what does it feel like down there? Because in New York, it's felt pretty awful the past couple of weeks.
Well, I mean, the people that are involved in the financial markets obviously worry about the same things, and it's a worldwide business, and the worries are worldwide. On a day-to-day basis, I don't think we get as whipped up about the market as New York does, but it still is obviously, well, or at least for those of us in the business, it's an ongoing worry that what's going on.
So how are you taking it as an investor? Obviously, cooler heads need to prevail here, and you wouldn't be outperforming your peers with such a long track record if you hadn't had that mindset in the past. What are you doing with your portfolio?
Well, we're not doing a lot. I mean, we're a low turnover manager, long-term investor. I mean, we're trimming. We've been reducing over the last year or so our exposure to Latin America. We've been reducing some of our bank exposure. We have almost no banks in Europe itself. We've got two bank positions, and they're for specific reasons. We've been adding to stocks in the United Kingdom. That's an area that kind of gets left off the map. We talk about Europe and we think about the pigs, or we think about Northern Europe, which has been our strategy, Germany and Sweden. But we've been adding to the United Kingdom, owning banks.
Jim, you talk about scaling back in Latin America, but as I look at World Equity Index performance right now, that's where we've seen some of the steepest declines. So perhaps you got out ahead of the train before it barreled down the track. But Brazil down 23% this year. Is it maybe time to get back in?
We have some real questions about Brazil. Their politics have changed a little bit. They, like Switzerland and some of the other countries, have a problem where their currency has been very strong, and this has hurt domestic activity, export activity. We've got some questions about Brazil's economy at this point, so we don't see any hurry to go back there.
Now, you are free to invest some of your money in the United States. Do you feel as though, with the S&P trading at something in the order of 11 times earnings, there's enough value there for you to feel as though maybe it's worth allocating more of your money to the U.S. stocks you can buy?
Well, I'm on the international side, but we also have a global product that makes that asset allocation, and our U.S. weighting is a little above average versus the international. We do see the opportunity in the domestic markets. We think they're getting cheap. Yes, we have our problems. The folks in Washington don't seem to help anything. And implicit in that is there going to be a second recession? We're in the camp that yes, it's possible, but we don't think it's going to happen. We're having a slowdown, and we think that's going to be the extent of it. Okay,
so if the questions will continue to be asked, because nobody knows when the economy is going to pick up, Jim, what kind of an equity market are we likely to see globally?
Well, we think that when it comes back, that it still is. There's a lot of room for cyclical recovery. So while short run we're raising our rates in our weights rather in the more stable areas like beverages and paper and stuff like that. Long run, we still think that the activity is going to be in the industrials and the consumer cyclicals, as eventually the consumer will get his financial health back.
Jim, you told me last time we spoke in June that you own some Canadian banks. Financials have really been taking a hit lately. Are you growing concerned that maybe there is nowhere to hide in financials and it's time to stay out for the time being?
We like the Canadian banks, and while they've been hit less than a lot of other banks. We also like the strategy of investing in insurance versus banks. The difference is that banks are subject to runs. I mean, I know run is kind of an old-fashioned word, but that in essence is what's happening in Italy and in Spain and France, where the hot money is trying to make a run at them that scares away their depositors. And these banks have to roll over their financing. A lot of it is short-term money. The insurance companies, most of it's long-term money. So they may have some of the same. They may have some of the same junk in their portfolio, but they're not subject to the old-fashioned run. And by the way, what's needed is for the European Central Bank and the authorities there to do, in essence, what our authorities have done, which is said, you know, we'll do what's necessary to keep these guys from going under. Putting
a floor into the market. Jim, good to see you. Jim Moffett, Chief International Strategist for Scout Investments in Kansas City.